May we be upstanding for the national anthem.
Stand and sing of Zambia, proud and free, land of wake and joy in unity, victors in the struggle for their right. We've won freedom's fight, all one, strong and free. Africa is our own motherland, fashioned with and blessed by God's good hand. Let us for her people join as one, brothers under the sun, all one, strong and free. One land and one nation is our cry. Dignity and peace need Zambia's sky, like a noble eagle in its flight. Zambia, praise to thee, oh one, strong and free. Praise be to God. Praise be, bless our great nation, Zambia, Zambia, free men we stand under the flag of our land. Zambia, praise to thee, oh one, strong and free.
We may remain standing for a prayer by Mrs. Gloria Chongo, our Manager, Security Operations.
Let us pray. Our kind and loving Father, we come before you with thanksgiving in our hearts. Father, we thank you for today. We thank you for your mercy. We thank you for your grace. Lord, we pray that as we start this meeting, may you start with us and end with us. And most of all, Lord, we pray for love and unity amongst all nations. In Jesus' name we pray. Amen.
Thank you very much, Gloria. We may be seated. The Governor, Deputy Governors, members of the Monetary Policy Committee, members of the press, ladies and gentlemen, good morning. Welcome to our third Monetary Policy Media Briefing. As you are already aware, the Monetary Policy Committee held its meeting over a 2-day period from Monday to Tuesday, and this morning, the Governor will be announcing the decision of the committee. As always, we are live on ZNBC TV1 and the Bank of Zambia Facebook page. Allow me to acknowledge the presence of our online audience who are following this proceeding using those channels. We thank you for your time. We have on stage the Governor, who is accompanied by the Deputy Governor in charge of operations, Dr. Francis Chipimo, on his right, Deputy Governor in charge of administration, Mrs. Reka Muhango, on Governor's left. Next to Mrs. Muhango, we have Director in charge of economics, Dr. Jonathan Chipili. And next to Dr. Chipimo, we have Director in charge of bank supervision, Mrs. Gladys Chiwele. My name is Besnat Mwanza, Assistant Director in charge of communications. I will be your Director of programs this morning. Without further ado, I will at this point in time invite the Governor to address the press. Governor, sir.
Good morning everyone, and a very warm welcome to our third MPC meeting for 2022. The presentation this morning will proceed as follows. There are 13 sections, but not that long, so don't be discouraged that there are so many sections. We'll try to go through them as quickly as possible, but ensuring that we get the message as clearly as possible. So I'll start with the pronouncement on the decision that the Monetary Policy Committee meeting has made over the 2 days that we have been meeting. That will immediately be followed by a brief discussion of global economic developments, in particular economic growth. Then I'll bring the discussion to home here by looking at domestic economic activity and the outlook. That will be followed by inflation outturn and outlook, which you, in any case, will have touched on in the first part where we make the decision. Then we'll move on to looking briefly at the government securities market and then interest rates, which is the money market, and domestic credit along with the money supply. Fiscal section will briefly look at the aspects that really relate to what we are doing here, because I think you have had a lot of briefings by the Minister and the Minister of Finance in general on fiscal affairs matters. Then turn to the external sector by sharing what we see where the current account is and the gross international reserves. Before concluding, we'll spend a bit of time looking at how the foreign exchange market is like and then provide a conclusion. The first part is the decision that the committee made. Yes, a lot of speculation as to what would be the decision of the committee. The committee decided to maintain the monetary policy rate at 9%. Of course, there are those who are hoping it would go down and those who are expecting that it could go up, but we'll hopefully be able to explain why the committee arrived at the decision that it did of maintaining the policy rate at 9%. So some of the key factors that the committee took into account was the fact that there has been a sharp deceleration in inflation in the second quarter, and our projections also show further decline to the 6 to 8% target range in the first half of 2024, in particular the first quarter of 2024. We also looked at what is happening in the domestic financial system here. We noted a lot of vulnerabilities that the financial sector is still faced with. We are still in the COVID range, although the pandemic maybe has receded. To assist the players in the market during the COVID pandemic, we had introduced the targeted medium-term refinancing facility. This has run its course, and we are seeing that with that coming to an end, there is some struggle in terms of credit expansion, as I will explain later in the presentation. We note also that there is relative tightness in the domestic liquidity market. I think we have heard the Minister also of Finance saying that some of the allocations that were made to certain projects still haven't been utilized. So that is contributing to the liquidity tightening that we are seeing in the economy. So that, along with the discontinuation of the TMTRF, to some extent contributing to that. But there has been also the aspect of foreign exchange operations, which, as you see later on, have had a withdrawing effect of liquidity from the market. We note also that the economic growth still remains weak. You will see later on that over the medium term, we do see some projected growth, but is still not high enough, obviously, to address some of the challenges we have. Notable in this regard is the high unemployment and the poverty levels that are widespread in our country. So, in a nutshell, we maintain the policy rate at 9% because we see inflation is coming down. It's to a single digit, but we note that there may be some instances, especially in the fourth quarter and perhaps first quarter of next year, where it's still elevated, but over the forecast horizon, which is 8 quarters, it is coming down, such that in the first half or first quarter, to be precise, of 2024, it will be in the target range. So the vulnerabilities in the financial sector also made us look at this issue more carefully, along with the weak growth that we are still experiencing. So let's now go down into some details of some of these factors. Firstly, we look at the global economic growth. You see the chart on the right here showing that in 2020, obviously, due to COVID, we had a recession globally, but that quickly turned in 2021. But there are still some pressures for the global economy not to grow. So what we note is that in July, which is just last month, the IMF, through its World Economic Outlook, made adjustments to the projections or the outlook, where actually they adjusted downwards the growth prospects by 0.4 and 0.7 percentage points in 2022 and 2023 respectively. So that's the chart there we are showing. So if you look at the legend there, we show the July, which is the extreme right legend there. That's where you see that purple line below there showing that the growth is actually projected to be lower. These revisions were occasioned by a number of factors. Principal among them was tighter global financial conditions following contractionary monetary policies by major central banks. I think what you note is that arising out of the Russia-Ukraine conflict, prices of commodities have gone up, and in that process, inflation has gone up quite high in a number of countries, including the developed countries. So as these countries are reacting to that, they have raised monetary policy rates, which is resulting in tightened financial conditions. Now, one of the ways we see this for our economy here is principally in the foreign exchange market and also in government securities, the portfolio players. So with rising interest rates, particularly in the US and Europe, there is this shift that tends to happen, that there is flight to what you may term quality or yield, because with rising interest rates, it means that the returns on investment in those jurisdictions is raised. So that creates a challenge for many of our countries, that there is capital flow reversal. Then we see that COVID, as I indicated, hasn't quite left us. There are new variants which do pop up from time to time, and authorities tend to institute measures to contain that, and in so doing, these do have an effect on supply chains, and that is one of the reasons which the IMF is cited for downgrading the outlook. Then in China, for example, there were some challenges of real estate crisis, and that too weighed in on the downward revision in the outlook. Consumer spending, obviously with rising inflation, you don't expect that to be buoyant, so that has also come down, which has a bearing on us who are exporting commodities, because when there is low consumer spending, that results in lower uptake of those commodities. So putting all these together resulted in the fund making that downward adjustment to the outlook both in 2022 and 2023. We'll see what happens in the October the publication. Now, these obviously pose challenges to our livelihoods, and in particular that the growth is not going to be as strong. So now, when we look at commodity prices, I think if you look at the second column from the right, which was the column I think we are looking at last time when we were meeting here, you see that there has been a marked change from that time to now, particularly in the second quarter. Of all the commodities except copper, which declined by 4.5%, all of them have gone up, some even significantly. Look at the price of crude oil, for example. It has moved from $96.5 per barrel to $108.90. Look at the price of wheat also. It has gone from $370.40 per ton to $415.20. I think you see the story there, even for soybeans. But here, I think maybe these are some of the opportunities people say, because here I think it's the other way around. You have, I'm sure I heard people talk of soybeans prices coming down. So maybe it's an issue of how do we take advantage of this. And more recently also have seen the price of tomato, for example, coming down very significantly. So these are some of the things I think as a people, as a nation, we need to look at very carefully, because there could be very, very ready opportunities that we can exploit. So when we look at the domestic economic activity, what we see here is some bit of a pickup in economic activity in the second quarter, and that's consistent, I think, with some of the lifting of some of the restrictions which were there. I think in a number of places now, people actually move freely without even wearing masks. So conferences, for example, here in Zambia are going on in Livingstone. So in other places as well, things are beginning to happen. So what we see is that using our survey here, we see that there is a pickup in some of these activities. I think we show this. If you look at this web chart here, the spider chart, it tells quite a lot. If you focus your attention for a moment on the red line, because that's the one which shows the second quarter out 10 or position, and then look at the blue, which is the previous quarter's position, you see that virtually now in all corners which point to the factors that are being measured, the red wave is larger. So that's what we are talking about, that there is a pickup in economic activity compared to the previous quarter. Now, if you look at the average, which is depicted by the black dotted circle there, I don't know if it's a circle or a hex, I can't describe the shape. You see that is wholly inside the ready web, so which shows that there is some positive news coming out of the economic activity in the economy. This is from the Bank of Zambia quarterly survey of business opinions and expectations. Now, if we look at also the Stanbic Bank Zambia PMI, this is the Purchasing Managers Index. This also, if you may move, but before you do so, just to cite those figures which are there, that on a quarterly basis, the average was 50.1, which is better than the 49.9%, not percent, is an index for the previous quarter. Those are averages. Then we see that in July, in fact, it moved to 50.5. Now, if you may move to the next chart and the next, yes, this is what we are talking about here. So how to read this is that you see there is that dotted line at the 50 point on the y-axis. If you are above that line, it shows that there is some positive economic activity. So it's the direction, not so much the quantum, but obviously if the bar is higher, it means that there is more activity. But you see where we are coming from. If you look in 2020 where that chart was and to where it is now in July, you can well see that there is some activity going on. But obviously, I said at the beginning, is still not big enough for us to kind of say, yes, we are in a positive territory in a sustainable way. So if you may move on to the next chart, please. Yes. So in terms of real GDP, what we are showing here is that there is a gradual pickup projected in the medium term for our GDP. I think I did mention that there is some positive numbers. So if you look at the forecast, you see that in 2022, it's 3.1 that is projected. That moves to 4.0% in 2023 and to 4.1% in 2024. So this is what we are saying, that there is growth, but we want this growth to be robust so that we can be able to make a dent in widespread poverty as well as employment creation. So if you may move to the next chart just to show this. So this is graphically how it looks like. So there are three sources for these projections. We have our own Ministry of Finance here. That's the red dotted line. You can see that it's showing those figures. Then we have the IMF World Economic Outlook. Unfortunately for this, the July revision doesn't show all the countries, so we'll have to wait to see how they project in the October publication. Then there's another group of economists, that's their projection, the blue one. You can see that it's more conservative in terms of what they expect growth to be. But the point is that we are on the positive growth path. We are not in recession, but we need to strengthen that growth. Having said that, I think we are alive to the fact that there are still some risks, upside risks to this growth. Notable in this regard is the impact of the Russia-Ukraine conflict, the resurgence of COVID-19 pandemic, some of these variants, tight domestic and global financial conditions, as well as a slow recovery in trade partner countries are downside risks to the growth that is being projected here. So moving on to the inflation outturn and outlook, what we are saying is that inflation declined for the third consecutive quarter to an average of 10.5% from 14.1%. If you may go to table 2. Now, if you focus for a bit on this table and look at the last 2 columns of that table, the outer column is showing the Q2 position, which is where I picked those figures. You have 10.5, and then the second from the left is the 14.1. So these are quarterly average. So that's the overall inflation. Now, if you look at the components of that inflation, which are mainly food and non-food, you see that they too have come down quite considerably. For food, for example, it has come down from 16.1% to 12.8%, and for non-food from 11.6% to 7.5%. Now, if we look at the quarterly end periods rather than the averages, this is what the bottom part of the table is showing. There too, you see that overall inflation has moved from 13.1% to 9.7%. Food moved down to 11.9% from 15.3%, and the non-food from 10.3% to 6.9%. So I was explaining the first point here. Then there is this aspect, I think it has come time and again, as how is it that these are moving. So we are saying that, and which the interim statistician general also labored to explain, that the dispersion of base effects, in this particular case we are citing those of chicken and the charcoal, the appreciation of the kwacha against the US dollar, and improved supply of vegetables accounted for the decline that we are seeing in inflation. If you look on the left panel here, you see what we are showing here is the effect on chicken. The right one is on charcoal prices. So back to the left panel, what you see, the blue line, that is tracing the price of charcoal, the charcoal per 50 kg. These are prices. You can see that it's rising, okay? But if you now dissect that change on a quarter by quarter basis, then you look at the bars, those orange bars. What you see that the highest increase happened in Q1 2021. Since then, prices of charcoal have been going up, but they are going up at a slower rate. So if you look at the size of each of those bars, that's what you are talking about, it's shrinking. So because the comparison is changing, since that line is going up, you have a starting point. So as you move up, the immediate point, it's this sharp increase. But as time goes up, you are also moving along the line. So the distance between the first point and the next point is getting smaller. That's what those bars are showing there. That's for charcoal. Now, it's important to understand here, we are not saying that the price of charcoal has come down. We are saying that the rate at which the price of charcoal is going up has reduced. Okay? Now, in that regard, since there has been no other disturbance, this over time will pass out. That's the base effects we are talking about. So you see that when you move, for example, in Q1 2022, it had actually even very minimal change. So it was almost flat. this is shown a lot better on the right panel, which is that of chicken. We have two types of chicken here, the frozen chicken and the live birds. There we show that the quote-unquote live, that's that grayish color. Then you have the blue line, which is on the top, shows the price per kg. Then you get the yellow and the orange. The line is the orange, that's now the frozen beds. Same concept. You see that those bars are getting smaller. We had Q2 2021. You see for charcoal, the peak was in Q1 2021. For chicken, it was Q2 2021. So these are things which Zamstat is following, and when they go, they find that there is no more disturbance, then the change is smaller. So that's what we are talking about when you say base effect and why we are saying inflation. It's not to say that prices have come down. They are still high, but the rate at which they are changing has reduced. Now, we see that in last time, I think what happened was that on June 30th, I think that's was the day when we had a meeting, there was a meeting, we were at the trade fair, I think, when this happened. And the people are saying, oh, is inflation going to change for the month of June? Of course not, because that change had just been made. But we're mindful that in the subsequent period when information is collected, obviously this was going to show up in the prices for July. And indeed, that's what happened. So when the fuel pump prices were raised on June 30th, we see that transport costs did go up following that, and that pushed inflation for the month of July up to 9.9% from the 9.7 that was recorded in June. Now, this is graphical depiction. Here again, we are showing two aspects. The left panel is showing quarter-on-quarter changes. The right one, those are year-on-year. Now, you see how quarter-on-quarter the inflation is behaving. I think I did allude to, if you take the middle line, which is the composite inflation figure, which is what is we follow, you find that it has moved from 14.1 to 10.5. Food, which is on top, has moved from 16.1 down to somewhere there around 10.5. The same for non-food, you see 11.6 to 7.5. I think I explained this. Now, the right is year on year. You see it's a bit smoother because we are looking over a longer time period. But once you look in the shorter part, you see that there is a more pronounced kind of change. So this is what we are trying to explain. Now, over the forecast horizon, we didn't give you the chart here, but I think we explain it. We see that inflation is projected to decline to an averages of 11.4% in 2022, 8.4% in 2023. Now, in last year, in the period that we are referring to, the outturn was 22.1%. So you can see it's quite a huge decline in inflation. So that is one of the reasons why we felt that it gives us time to observe how these things are happening so that the other reform measures that are being undertaken can take a root. Indeed, you see that in the second bullet point there, what we are saying that this projection takes very, very seriously the measures that are being implemented, that is sustained implementation of fiscal consolidation and the structural reform measures, as well as benefits that we expect to get from the extended credit facility from the IMF. So when we put those into the models that we are using, that's what is giving rise to those numbers that we are sharing with through. Then when we look at the other aspect, that with these developments, they do work out through the exchange rate and the interest rate channel. So once they take root, they do boost confidence and in so doing anchor inflation expectations. That in turn should help to foster a macroeconomic stability and sustainable growth. So that is critically important for our economy to grow and for also to reduce the cost of doing business and so on and so forth. So these are not trivial changes. They are quite fundamental, that once they take effect, the impact on our economy is quite significant. When we say that the benefits associated with that, there are quite many. One of them is obviously the issue of restructuring our debt. So once that debt is restructured, it means that the outlay for debt service will also be reduced. Right now, we are only some kind of a standstill where we are only servicing the multilateral debt principally. So the non-multilaterals we are not servicing, awaiting the conclusion of this restructuring under the common framework, which was pronounced by the G20. So once those take effect, we should see more impact on the economy. Then, as we do that, we are not blind to the fact that there are risks that can make this inflation not hold, or the projection that we have made. Among these are persistently elevated energy and the food prices. So if the conflict in Russia and the Ukraine prolongs, then it means we have to contend with a prolonged high elevated energy and the food prices until, of course, other alternative sources are identified. And this is where others have said, including the president, to say that, look, this is an opportunity to really look where can we take advantage of this crisis that we have. Then we see that although we did have some surplus of maize, others were not as fortunate as we are, so they will be looking to procure maize from ourselves, and in so doing, that will push the price of maize up. So that's a risk we are flagging. There is the aspect of the COVID-2, which hasn't gone away, as I said. So as we grapple to contain those, they have these adverse impact on economic activity and the livelihoods in general. So we must be alive to that. The weakening global growth and the higher inflation, that too has the potential to raise inflation here and elsewhere. And finally, the tight global financial conditions. I think for some countries, this is really feared the most, that all the flows that were coming our way could be reversed, and then we would have problems in getting our economies going forward. More importantly, here we are referring to inflation. Then in the government securities market, I think there has been some information here that the subscriptions are down. That's what we are saying here. But I think it's important to know this, that yes, the subscriptions are down, but the way the size of the auctions it determined is that it doesn't necessarily mean that when you have a shortfall in the subscription, then you will not be able to meet your maturities or maturing a government paper. The setting of those volumes or the auction sizes takes these into account. Some are larger than others, just to take account of the fact that you will not always be successful to get 100% of what you are looking for. So sometimes you find you are more, other times, but on average, you should be able to be raising enough resources to fund government activities. But that it's declining obviously points to that the appetite perhaps is waning. Part of it is what I explained earlier, that the tightening liquidity conditions do have this effect. If the government is not spending as much, then money is not circulating in the economy, and then people cannot participate in this. But if government securities are not doing well, but private sector credit is growing, maybe we would say, well, there's a counterbalance here. The government is not crowding out. So there is a balancing act that we do. But as you see later, we see that credit growth, even to the private sector, was not as strong, and that is a concern that the committee had to take into account. So in terms of the figures, we see that the outstanding stock of government securities increased by 1% to 203.3 billion kwacha. And the bulk of that, 81.4%, is in government bonds. And non-resident players reduced to 26% from 28%. There again, pointing to the issue I was saying, that these people moving out of this, what we are seeing also is that the coupons, because the bonds, for example, there are two payments which are made. There is the coupon payment every 6 months, and then at maturity you get your interest. So usually what happens that when they get those coupon payments at 6 months, they would want to plow them back into the market. But what we have observed recently, that those are not being plowed, and hence the pressure sometimes we see in the foreign exchange market, because they want to convert those kwacha earnings into dollars, and that puts pressure on the foreign exchange market. So this is just a picture of the divide between the treasury bills and the bonds, which I explained. The bright orange there, that gives you the government bonds, and you can see the treasury bills, the blue line there. Interest rates. What we see that in that space, interest rates, I think movements was mixed. When we look at the interbank rate, which is what we focus and what this MPC, the monetary policy rate, targets, you find that this remained virtually unchanged at 8.9%. And throughout the quarter, it remained within the boundaries that we set. So those are the boundaries that shaded part is the top 10, the lower 8. So the policy rate is at 9. So that green line is what we are referring to. You see that it remained well within that corridor. So for purposes of using monetary policy rate, I think that was successful. Now, we look at now the commercial banks. What we see that the commercial banks' average nominal lending rate was also broadly unchanged. Now, at 25%, that's quite elevated, but it didn't change. Now, when you look at the 180-day deposit rate for amounts exceeding 20,000 kwacha, this actually declined to 6.8% from 7.5%. Further, we see that the weighted average treasury bill and bond yield rates, on their part, they rose because there was a reduced liquidity in the market. So they went up 13 and 22%. You can see that 22.1% versus the 25.2%. This is what we often point out, that for as long as these are that high, because these are risky-free rates, investors, notably even the banks, who tend to pack their money into that because that is risky-free and do not lend as much. And that's what we are working very hard to change, so that the macroeconomic environment is such that the yields on government paper are lower, so that they don't put this upward pressure on interest rates generally. So see chart 9, here you see the top part, that's where the contention is. The red one, that's the average lending rate. The green one, that's the average bond rate. You can see it kind of pointed up. And then the blue, that's the weighted average treasury bill rate. Again, you see that moved. But what had been happening is coming down. So if there is more liquidity, you may find that it is coming. And here again, I think that's where the significance of the ECF comes in, because up to this point, external financing has been all but non-existent. But with the coming on board of the ECF, we should then be seeing external financing coming into the economy, which will reduce the pressure on the domestic market to fund the budget, as it were. Now, domestic credit, I did point out this already. You see that in June, domestic credit growth actually slowed down to 6.8% from 11.5%. So if you look at that chart, that's very concerning. Now, you see the red, that's the credit to the government. Look at the blue, very, very minuscule. That's the private sector, and that is what has to change. We want to see more of private sector credit going, so that the adage of saying that the private sector is the engine of growth can come to pass. But where we are, that's not what is happening. Now, there is exchange rate influence on this. If you look at the black line, that's the overall growth of the domestic credit. But if we remove the exchange rate influence, that's the dotted line, it kind of goes up, but not high enough anyway. So what we are saying too in this regard is that in June, credit were decelerated to 12% against 16%. Credit to the private sector actually contracted by 2.1% year on year, relative to 1.3% growth the same period. Now, that is what that chart is depicting, and that's what the committee is concerned about, that no, this is not pointing to a situation where we can have sustained, stable growth. Money supply, that credit is coming down. It shouldn't surprise that the money supply is also going down. So what we see here is that the money supply contracted further by 5.2% year on year, as shown in the chart there. So what you see year on year growth is that red, and you see how it has moved. Then if you look at the quarterly change, that's the blue there, you see that it's showing some up and down. But when you remove the exchange rate influence, that's when you get the dotted a line there, but still all of these are pointing in the downward direction, and that's not what we'd like to see for the economy to grow. Fiscal policy. Here we are not saying much because a lot, as I said, is said by the minister, the ST, and the other colleagues from the Ministry of Finance. What we are saying here is that the preliminary data indicate a lower cash fiscal deficit in the second quarter, largely on account of reduced expenditure amid strong revenue performance. A standstill on external debt service, principally to non-multilateral creditors, and lower spending on capital projects underlie this outturn. So here I think you have heard the minister say we need to release and spend some of the money which has already been allocated. So going forward, we expect that there will be some activity which could help reduce the tightness in the financial conditions in the domestic market. But there are risks which must be borne in mind. Among these is again the Russia-Ukraine conflict, because what that has done has pushed the price of energy and the food prices already. I think the government has had to revise the budget for the agriculture support program, the fuel, they had to postpone certain reforms that were to be undertaken because of that pressure. So we hope that the war does not prolong, because its prolonged stay has these very, very adverse effects. Now, turning to the external sector, what we see is that the current account surplus is narrowing from $0.2 billion from 0.5. So this is the chart on the right. Now, if you just look at, it's coming down, it's narrowing, that may send the wrong impressions. What it means is that, why is the current account surplus narrowing? I think it's because there are more imports being procured. What you see there is that imports actually grew by 23.3% to 2.1 billion, driven by some of that information we shared with you, the pickup in economic activity, and also the appreciation in the kwacha had something to do with it. Now, what is important is to look at what underlies this narrowing. What we are observing is that there is a lot being imported in the way of raw materials and other inputs for the productive sector. So to that extent, then it portends well for growth going forward. It would be worrying if the over concentration was on import of consumer items, because then those are consumed, as the name suggests, they don't go into the productive process. But if the imports are for inputs into the productive process, then you should see that paying off in time. Having said that, again, we are not saying that we should be really celebrating that is the case. What we should be looking at, what can we be producing of some of those imported items? What production processes can we embark as Zambians to be able to stem some of these inflow of imports? Because for as long as we continue to import more, it means we need more foreign exchange. And if copper, which is the main export commodity, is not doing well, it means that we have problems, and the exchange rate volatility will not leave us. Now, I said that imports went up by 23.3%. In contrast, exports declined by 2.2% to $2.9 billion. Now, the service account, you see that the deficit there widened. Why? Because of higher transportation costs to move those imports that we are pointing at. You know, the balance of payments, as the name suggests, it has to balance. What goes in must come out somewhere, so it's a complete cycle. Reserves, there has been a slide, I think this information we already shared it during the trade fair and the show, that our reserves as at end June were standing at $3 billion in terms of import cover. That was covering 3.7 from 3.6 months of import cover. So what you see is that I did already allude to the fact that imports come. Now, what we use here is really the prospective imports. So what you see to arrive at that is 3.7 months of import cover. The corresponding number or for imports was 9.8 billion. And for the previous quarter, the import figure was 9.4 billion. So that is moving up, but reserve build up is slow because of some of the challenges that we have in the market. So we give you a chart there to see where we have come from as well. Now, where do we get our inflows for to build up reserves? Principally in two sources this time around was mining tax and receipts of some of the project funds that have been lying in some accounts. Foreign exchange market. Yeah, as I said, this is one of the most talked about area, is particular the exchange rate. What you were saying that during the quarter under review, the kwacha actually appreciated by 3.4%. Now, how did that come about? What we observed is that there was increased supply of foreign exchange in the market relative to demand. Now, other factors also came into play, notably positive sentiments arising from the pronouncements which were coming from the IMF and other quarters to say that having now gotten the official creditor committee meeting, the prospects for getting an extended credit facility were very much enhanced. So that kind of removed some of the adversity which people had in our economy. So in so doing, it meant that that demand which was incensed for dollars was somewhat reduced. Then with some supply also going up, remember this was the time when the copper prices were also high. So we did get quite a bit of resources from the mines in the way of mining taxes. Now, these charts, for you will see that these are charts which are stable and is straight line you can draw. But I want to let you know that it's not that easy on a day, for example, intra-week, intra-month. There are so many factors to balance out. So whereas you may see that, well, the exchange rate is this, but behind that, there is quite a lot going on. So when we are saying that there is this supply, I think the next part will show this. What we are saying that, you see, total supply was $2.1 billion. Now, out of that, the Bank of Zambia got $494 million by way of taxes from the mines. Now, supply was that high, demand was relatively low, but when you look on the right hand side, the chart there, if you look at the black line, that's the supply without the Bank of Zambia involvement. But when the Bank of Zambia gets involved as it did, you see that supply goes up. So now, if you look, we got 494 million, but 424 million of that was put back into the market. Why? It was put back because there are these ongoing pressures for exchange volatility. Now, that is also enhanced by the increased prices of petroleum products and the fertilizer. Well, fertilizer is by and large coming from petroleum, but that going up meant that you needed more dollar outlay to meet that requirement. So you can see that out of 494, 424 went back into the market. Now, people may say, well, why are you doing that if the supply was there? This is the crux of the matter, that there is underlying volatility in these markets. So how do you smooth the movement? You smooth the movement by supporting the market, and if there's no supply elsewhere, that's what you have to do, and that's why the 424 million was put back into the market. So the argument that we often hear from that, no, the Bank of Zambia is taking the resources away from the market, and that's why you have this problem. It can't be further from the truth, because numbers point to something else. They point to the fact that actually you're applying. What has changed, though, is that whereas before the bankers to the mines were the ones who were receiving these monies, but our market is a segmented market. What do we mean by that? We mean that not all the banks are of equal standing, and these banks have relationships. So some of the banks do not have a relationship with those who have the resources. So even if they wanted to get those resources, but someone else has, that trade does not go. Now, when the bank is the one which receives that, we are seeing all this. Sometimes someone is saying, no, there's no money, but we are seeing there is money, you know. So to smoothen that, then we go into the market to offer that through the established channel, which is the IFM process. So that way, even those who are not bankers to the mine, or who will not get supply from those who have that, would have a chance to get. That way the economy is provided the liquidity that it needs for foreign exchange. So I thought that it is important to understand that dynamic which is underlying this market. It's not straightforward that no, you have more, then you do this, and that no. We constantly look at what are the pressures. Some pressures come at different time. You have the inflow, but there's no outflow. The other times you have outflow, but there's no inflow. Just the same way the government tries to manage the fiscal resources. Revenues do not come regularly, but expenditure is always there, and they have to manage that as best as they can. So similarly, we have to manage this situation in a manner that volatility is addressed in the market. Conclusion. Just to recap, we maintained the policy rate at 9%. Why? Because we see a sharp decline in inflation in the second quarter, and our projections also show that inflation will be coming down by the first quarter of 2024. It will be in the target range of 6 to 8%. But we also note that there are vulnerabilities in the financial sector, which if we ignored them completely, that could be another challenge that we have to deal with. we see that there's relative tightness of liquidity in the domestic market, which needs to be managed, and we see that the fiscal has a say in there in terms of the spending plans that they have. Then domestic growth is also quite fragile, and we need to cultivate an environment that will help make that growth strong and sustainable. So finally, we say that there are upside risks that we must be aware of, and we outlined these at great length to you, and you'll see them in the paper and the actual statement. Thank you, and God bless.
Thank you very much, Governor. So there you have it. The monetary policy rate maintained at 9%. The factors that the committee considered were ably stressed by Governor. At this point, we are going to go into the question and answer session. And in the interest of time, we'll take 3 questions at a time. The first 3 will come from the audience that is here, and the next 3 will be from our online audience. In the interest of time, we have quite a number of questions that have come through the social media platforms, but we will only pick 3, and the rest we will provide answers through the same channel that was used to send through the questions. So for those that are here, if you've got a question, please walk through to the microphone that has been set up for this session. State your name and the institution you represent. Then you can proceed to ask your question.
Good afternoon. My name is Cecilia Chiluba from Money FM. What is the latest update on the BOZ gold purchases? Is the central bank open to increasing participants in domestic gold auctions, such as pension funds, retail investors, and other institutions, to allow Zambia to retain more of its gold? Thank you.
Good afternoon. My name is Prudence Chota from Camnet TV. My question is in regards to cryptocurrency. Do we have laws, Governor, that are regulating this? We've seen a lot of activities happening in this area in the country, but as far as I'm concerned, we know that this had no regulation from the bank. And we've seen online adverts, we've seen people teaching people about cryptocurrency and things like that. So I wanted to find out. Then lastly, this question I'm asking on behalf of someone who wanted to find out on the kwacha's appreciation against the United States dollar. Why is it that when the kwacha appreciates against the United States dollars with a particular margin, it does not reflect that to currencies such as the rand? You find that kwacha appreciates from 20 to 16, but rand it's only from maybe 1 kwacha 2 ngwe to 1 kwacha 1 ngwe or 1 kwacha. Thank you.
Anyone else from this audience? I see none. Governor, you may proceed to answer those questions.
Thank you very much for these questions, to those who raised the questions. I'm accompanied by colleagues here who have more granular information. So if you don't mind, Cecilia, on your first question on the gold purchases, how much have we got? I don't know if did you or Isaac, can he give you the latest on that? And also, why is it that can we allow private players to participate in the gold auctions? I think that one is a tricky one because it's not the same as we are not auctioning. But anyway, maybe help to shed some light on that.
Thank you very much, Governor. Cecilia, thank you for the question. I think gold, from the time we've began purchasing gold, we've purchased about 72 million now in terms of gold bullion, because I think we've explained before that we are doing 2 kinds of gold purchases now. The first is gold bullion, which is actually refined to the highest standard so that it can go directly into our reserves. and this is from some of the major mining companies, and so there's 72 million we've essentially purchased since we began the program. And then we have also been purchasing what we call Door Gold, which is not yet refined to the highest standard, and we have purchased about $6 million of that. And the bullion gold has been about 39, more or less 40,000 ounces, if you like, which is about 1,200 kgs. So that's what we've purchased. We continue to purchase gold through those processes. I think in terms of the retail participation, it's important to understand, first of all, why we purchase gold and how we are able to do it. So we purchase gold because we want to build up reserves. For gold to be classified as a reserve, it has to be of a particular standard, and that's the bullion standard which we have, which has to be refined by recognized refiners. Currently, we have that refinery taking place in South Africa through the Rand refinery. So we can only really purchase gold of that standard, and typically we're purchasing it from producers. Now, we have been also purchasing gold, as you know, we've said this before, from Zambia Gold. This was prior to them ceasing to operate, although they are now on their way back to beginning production. And so that was Door Gold we were purchasing from them, and we were in the process of trying to make sure that we can have that gold refined so that it can go into our reserves. So the bigger picture with ZCCMIH and Zambia Gold was that indeed we want to be in a position where we can purchase gold locally, have it refined. We provide in that purchase obviously incomes to the people we're purchasing it from, and obviously to the communities, in the sense that they have people who they work with, and that goes into our reserves. But the process of refining is also quite involved, because all the key refiners in the world will want to make sure that that gold is mined in a responsible way, you're not using children, and all of that kind of thing. So there's quite a process for us to make sure that we can purchase gold in the right way for it to be able to count as our reserve. So that's really the constraints when you talk about who can actually participate in the gold purchase. We're obviously looking to participate, to partner with producers. I think that's on the gold.
Yeah, if I may just add on there's another aspect here, apart from the other challenges DG has raised. We are purchasing this gold using kwacha. So if now we are to do that, the chances are that people would want to be paid in foreign currency. Then now it's a substitution where we have to take reserves to buy that gold, which won't make sense. So with the producers, we buy in kwacha, obviously at the market price, but it's not likely that those who are producing or who are traders in gold would want to be paid in kwacha. That would be another complication, but we'll cross the bridge when we get to that. Yeah, so the other one, it was from Prudence. There are two questions that she raised. The cryptocurrency, there are any laws governing that? Well, for sure that currency is not issued by us. So that by itself should give you some concern, because should anything go wrong, it means you are on your own. So we have put out that statement that those who are participating in this, they are doing so at their own risk. We haven't got to that point yet where, in fact, crypto is very problematic. Maybe if you talk of central bank digital currency, that's where others have come in. But as we listen to more recently, we were in Banjul for the Association of African Central Bank meeting, where actually the colleagues from Nigeria shared their experience on the issuance of this digital currency. I think for them, it was a matter of necessity. The situation was that the naira was being undermined in the market, so they had to move to be able to be part of that field. So when we see this happening, I think we shouldn't jump to the conclusion that, no, we should also do that. You must understand our own domestic circumstances first and fully before we do that. Having said that, we are actively looking into this space for the digital currency. But the cryptocurrency is a problem because of the anonymity which is there, and you find that if something goes wrong, what happens? So we are not encouraging people to do that. You see, if you do, you are really doing so at your own risk. I don't know if you want to add something.
Thank you, Governor. I think maybe just to make 2 points. The first is we talk about cryptocurrencies, but really most central banks don't look at these as currencies. It's an asset which people are essentially trading. But we are concerned about some of the schemes we see where people essentially are using crypto as something they can trade with. And very often, some of these schemes, to the extent that they are offering a financial service in doing so, which they shouldn't be, are going to go fall foul of our laws. And when we do find those, we do obviously act within the context of you shouldn't be offering a financial service which is regulated. And that regulation can be either by ourselves or by SEC and so on, because there are all sorts of schemes which are there. But just as an asset which you're trading online and so on, that's not something which currently is regulated. Now, there are some central banks now who are putting out more and more sort of framework regulations for cryptocurrency, and I think, as Governor has said, we're looking at that space as well, just to see how we move. But the big issue I've said is, please be cautious when somebody tells you that they're trading in these things. Typically what is happening, they're going to tell you they're trading in these things, you're getting fantastic returns which you can't get from any sort of business you can reasonably think about. And when you see that, typically these things tend to be not what they seem. So maybe I just thought I'd add that on the crypto. I think on the appreciation, maybe Isaac can add in here. If I understand the question, you're almost saying, look, the dollar appreciates by 5%, the rand against the kwacha might not appreciate by the same. And if that's the question, the basic point, you have to realize that all of these currencies in the end are moving against the one standard. So the kwacha can move against the dollar today in a certain way. We're a commodity country, so it might be copper has gone up. South African rand might be also moving against the dollar. It's also a commodity currency, but maybe their gold is what is moving. And so at that point, you can relate what the kwacha and the rand is through these sort of cross rates, if you like. But the basic point is that these currencies are moving, even when you're just comparing it to the dollar, in different ways, because their economies are different and their economic circumstances are different. But Isaac, you may want just to add on that if there's anything I've missed out. Thank you.
Well, thank you. I don't think that there is anything much more to add, but just the last point you've made is very important to understand that each currency's economy is different. So, and each currency is determined by that country's fundamentals. So the fundamentals for South Africa might be different. Obviously, they are different from Zambia's. And so even the determination of the rand takes into account those fundamentals. So I think that point is important, even though both currencies, of course, are exposed to the US dollar in the manner in which you've explained, Tijo. Thank you.
Thank you very much. So the first question is, if the MPR is at 9%, what basis are banks using to charge annual interest of over 30%? According to the Bank of Zambia, is that reasonable? The second question is, what does the Bank of Zambia have to say on the pricing of goods that have still remained high despite their kwacha performance? What advice are you giving to the consumer regulatory bodies on this issue? The third question, how does a drop in inflation affect the interest rates on investment accounts? There's a general drop on the investment rates in the local banks by roughly 50%. Those are the questions, Governor.
Thank you very much. I think if you followed the conversation or the presentation I made, I did point out where I showed the chart where you have the different interest rates, the weighted average lending rate, and the yields on government paper. What you obviously see is that the yields on government paper are still quite high. So obviously a rational player takes all that into account. So the banks, they are not restricted, so to speak, in getting their resources from the central bank, which is what we are trying to push. But as of now, they are able to mobilize deposits. They are able to invest in government paper, which is fetching more. So when they do their analysis, they may find that, well, it's more lucrative to put the money in that channel rather than lend into that. So this is why we have a lot of work to still to do to close these other channels so that the policy rate really becomes the dominant rate. That will happen if the wholesale funds can be obtained from the central bank. That way then that rate will stick. But as of now, there are these noises which make it possible to really bypass that channel. We see it moving a bit, but not a whole lot. What you see, if the rate was, for example, reduced, tomorrow you will see banks saying linked rates will also come down. If it was to go up, they will say the linked rates will also go up. But overall, is really the issue of inflation, that we get it down to that range that we are talking about. But that won't be enough if that's the only thing. Because for macro stability, we must have the fiscal deficit also under check. We must have a stable foreign exchange earnings so that the exchange rate remains quite stable. So all those, when they combine, that's what is going to give us an environment where cost of funds will also be reduced and in a sustainable manner. So having said that, it's not to say that it's all gone. You are not making it. We can look where we have come from. The interest rates were in excess of 30%. Yes, some may still be charging that, but one of the things we are doing, which sometimes players don't quite see, we had been advertising what different entities charge, but you say that, well, they don't give us those loans. That's another channel, so which we have. So the government is working on these empowerment funds as a way of relieving some of that pressure. So the work is cut out for all of us to do our part to reduce some of this, and eventually we should be able to see that when we move the rate, it will actually have the desired impact. Now, you say that the goods remain priced even when there's an appreciation of the kwacha. The channel is not quite straightforward. The people have different consideration now. For us, we are really not in that space to go and say, you reduce the price and all that. But all our colleagues who are doing licensing are seeing what is happening. But as a country, we adopted a liberal system where we don't fix prices. Now, having said that, I think as consumers, sometimes we don't really exercise our right as consumers. People will be complaining about a service or a product, but still go and buy it. Believe you me, if you exercised your consumer right to say that if you don't like what you are seeing, don't give them the money, behavior will start to change. I mean, there was a time in this country where if you went to buy shoes, as an example, you are not even allowed to try them on, you know. They just say, no, what is your size? You know, you tell them the size. You are given. Sometimes you even when you go home, you find that it's of one size, one side. To take it back, you say, no, you took it already. So we have come a long way. The consumer competition is trying to police that. But we don't have the law where, in other settings where you say that, look, if, for example, the price of something is at a certain level, then there's a shock, then people just raise the price. Then you can call that usually, and you say, no, you are trying to profiteer from this. So consumer protection goes beyond just the agency. I think we used to have a one-man show who was really, Mr. Ilonga, I don't know where he is now. He is the one who was really fighting this to challenge the supplier that, why are you giving me this high price? So the dynamic is quite complicated, but for the central bank, we cannot go in and say, look, because the exchange rate has appreciated this, now you must charge this. We tried anyway in the new act to try and deal with that, but the people didn't like that idea of making the kwacha the legal tender so that you can do that. So what can we do? We have to follow the market dictates and try to push that agenda that everybody does. So I don't know if I missed maybe you go to the other point.
I think the last one was on investment.
Yes, and inflation.
Accounts and inflation, in the sense that perhaps I guess the point that your yields are not as much. I think from a policy side, I think one thing you need to do is to try and encourage competition, right? So that, the commercial banks have to offer you a bit more. Some of the things we're trying to do broadly in terms of, for example, government securities is an area in which people can invest in and they get much better returns. And we've been doing quite a strong marketing campaign to encourage people to go into be able to invest in government securities. But beyond that, actually, we're also trying to automate the process so that it's easier for consumers to actually just come straight and deal with the government directly through us as their agent in terms of investing in government securities. And we're trying to build a portal on the website to be able to do that. So the idea is some competition. But the other thing is you're seeing savings groups which are increasingly, in a sense, providing that a better return for each other, apart from just investment resources, but a better savings return. And again, we have some interesting people who are innovating in that space. I think we have a sandbox regulation. Currently, we have one or two people who have introduced some products which they want to test. So probably you'll be seeing some of those things on the market coming up soon. So I think the underlying is let's encourage competition so that you're not just forced to accept what you are given by the financial sector services.
Thank you very much, Governor. At this point, we have come to the end of our session. Let me take this opportunity to thank all the media institutions that covered us live on their channels, Parliament Television, Diamond TV. Thank you for your support. If there's anyone else that has supported us in this regard, we appreciate you. Until next time, thank you very much. Do have a blessed day. I will ask that we remain upstanding as we allow for the Governor and his entourage to leave the auditorium. Thank you.